Interest rates have cut, so down from 4.75% to 4.5%, so a quarter point cut. I guess that was perhaps of all of the things the most expected decision here from the bank. They have been cutting for some time, so they've come down from 5.25 down to 5, down to 4.75. Now it's down to 4.5%. That was expected. What I think wasn't expected is, so the Monetary Policy Committee, which is the 9-person committee that decides on interest rates, we get the results, so the minutes of their actual votes. And within those minutes, it transpires that 2 of the members actually voted for an even bigger cut, so to bring interest rates not just down to 4.5%, but down to 4.25%. That would have been a big deal, but obviously there were only 2 of them. They were outvoted by the other 7 people on the committee. But it's still significant. A lot of people will be looking at that and saying, is that a sign that the bank is likely to cut even more in the coming months? We knew up until recently, and looking at the market expectations, that it was expected to keep on cutting. But a lot of people would look at that and say that that's a dovish sign. In other words, you've got some people who are talking about more cuts than the market was expecting. That being said, then you look at the actual details of the bank's forecasts themselves, this stuff, this big document, and actually a lot of people would look at that and say, well, it suggests actually you've got fewer cuts coming in the future because they're expecting inflation to get down to 2%. That's their job. I mean, leaving aside everything else, they need to try and get inflation down to as close as 2% as possible. And the bank is basically signalling through its forecast that it thinks it can do that with potentially only a couple of interest rate cuts. So you've got this slight bit of insecurity about where we're heading in the future. But I think the bigger picture, Darren, is when you look at what's the numbers are suggesting beneath this, you're talking about quite big cuts to the growth forecast, quite big rises to the inflation forecast. You've got weaker growth, you've got higher inflation. Those are not the kind of numbers that Rachel Reeves would have liked to have read. And moreover, there is no upgrade as a result of the growth measures that we heard from the Chancellor just last week. The bank basically thinks that although this stuff may increase growth in the distant future, so you're talking about maybe 4 or 5 years, in the near term, there is no upgrade to the forecast. So that's quite significant. I think that will be a disappointment for the Chancellor, not to mention the fact that, as I say, there is now actually a little bit more doubt about how many cuts there are going to be in the next few months. Potentially 2, but I think a lot of people thought they were going to come down from 4.5 to maybe 3.5. Doesn't look like it according to the bank's overall forecast, and a lot more insecurity just facing the bigger outlook for growth in the UK right now.
We've actually heard, Ed, in the last couple of minutes from Rachel Reeves, the Chancellor, welcoming the interest rate cut, unsurprisingly, but also adding that she's still not satisfied with the growth rate, clearly in that response saying that the expectation for the Bank of England is the UK economy is going to grow at half the rate they predicted only a couple of months ago. And you're right in saying this is difficult stuff for a government that predicates their entire agenda on growing the British economy, but also is going to have to face some potentially very difficult decisions in the weeks to come about the public finances.
It's tricky, and when you look at the numbers here, specifically, the bank thinks that we've basically only just avoided recession. I mean, we'll only know when the numbers come in, but they think that essentially the economy contracted in the final quarter of last year by 0.1%. They think the economy is going to grow by 0.1% in this quarter we're in at the moment. That is really close. It's literally kind of a decimal place away from there being a recession, because 2 quarters of contraction mean you are in recession. That is clearly not where Rachel Reeves would have wanted to be 6 months after having taken over. And add to that the fact that there are many other threats out there, which obviously she can't control, things like tariffs. The bank hasn't downgraded their forecast because of the threat of tariffs coming out of the US. Some of those tariffs, to some extent, already been imposed, as we were talking about earlier on this week. They haven't downgraded their growth forecast as a result of that. But they basically do say it's hard to see this as positive, and when we get more detail on precisely who's going to face tariffs, we'll have to look again at our numbers. So you look all around, and there are not many things that are particularly encouraging when it comes to growth. That being said, The economy isn't contracting at the moment. Interest rates are coming down. There is still a big question mark, as you say, Darren, about what happens next month when the Chancellor gets the latest figures from the Office of Budget Responsibility. They need to give their latest forecast. Does it show that she is missing her fiscal rule? It might well do, although that much depends on what happens with growth forecasts and indeed with what's happening in financial markets. So there are still lots of reasons for her, I think, to be a little bit nervous about the situation right now.